You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
What up? What up? What up? Another day, another dollar. Paul Pasalakis. We've got Salvatore Kuzmano. We've got Brad Weisgerber. We are the trio of Inside Real Estate, IREpodcast.com, Facebook /IRE Podcast, or anywhere you get your podcast. Please like, share, comment if you appreciate our show. We've been getting a lot of nice comments lately about we did a finance episode last week. We had a lot of good feedback, and there was just so much stuff that we could talk about. So I figured we'd do one more episode, a part two, on kind of the refinancing and why it's so prevalent right now, why so many people should be looking at it. I think it's just a lot of people out there might have heard or read the news, but they're like, I don't feel like dealing with it and whatnot. And Sal and Brad, you guys have seen this. A lot of people right now, most people can refinance if they got a mortgage 6, 7, 8 months ago or before that, right? So the population of people that can refinance is so big, and there's so many things out there of misinformation that I believe that we could try to shed some light on some of the realities of refinancing. Today, I wanted to talk about really what are some challenges with refinancing right now, because not everybody can really do it because it's gotten tighter since COVID. And I also wanted to talk about kind of why refinancing, why it actually is so important to refinance. And I don't think people look at it properly. Sometimes they look at it like it's hard work, like it's going to be annoying. But if you're dealing with the right group, it doesn't have to be as shitty. You know what I mean? So Sal, I know you're doing a ton of them, right? But what you're seeing probably is that some people aren't qualifying because things have gotten tighter, right? Self-employed borrowers probably have a little bit more to have to do, lower credit scores. What's right now for you, Sal? What are some of the restrictions that have come up since COVID that are precluding some people from refinancing, like credit scores, for instance, right? Where before you can go down to 580 on an FHA, that's not as prevalent now, is it?
Yeah. I mean, it depends, and I mean there are lenders who do go down that low, but at least us and a lot of the lenders or partners that we've partnered with have increased their minimum FICO requirement, or they might have debt to income restrictions. There might be a few things that could affect them just from that eligibility, but some of the bigger things are just what maybe had happened to that particular borrower, like getting furloughed or a reduction in pay. Like they might have bought their home the end of last year on one salary, and now they're making 25% less. They're still making their bills, but on paper they might not qualify. Specifically self-employed people, it's been difficult because they require which it's funny. In the past it's always like, hey, I'm killing it this year, right? Like, can we use that income? And no, you got to wait till you file your taxes next year to use that income. But now year to date, profit and loss statements are required for self-employed borrowers on conventional loans, and it's definitely shook things up because one, you need an accountant to potentially put that together for you, and if not, it needs to be backed by business bank statements. So right. That's been a challenge for a lot of buyers, and as more self-employed loans are delivered to Fannie Mae, I think the guidance will either become permanent, in the future and a little more clear. They haven't been necessarily clear with what that needs to look like. How far can it drop? When COVID first happened, they just took a 25% reduction of self-employment income from last year, which,
right.
Again, I mean, a lot of people, their debt to income ratio hovers right around the end. They might have to pay off a credit card or something to close their loan. And now, unfortunately, they might not be able to take advantage of the lower rate. So that's something that comes up, and it's not like I would say like a very I would say it's common, but it's not like the majority of loans. But it's definitely something that if you are thinking about refinancing, you definitely have to think you still have to qualify for the loan. So if you're furloughed, or if you have a reduction in pay, or if you're self-employed, it might be difficult. and you want to get that out there up front, because what's the point of wasting all your time, especially if you need an appraisal and need to pay for it, you'll end up wasting your money, right? So
yeah, I mean that, yeah. I'm sorry to cut you off, but yeah, you're right. A lot. Go ahead.
I was going to say, just, specifically this past week, Fannie Mae and Freddie Mac essentially have put a 0.5 point hit on all the loans, right? And that's been,
I want to talk about
that's apart from the qualifying, so we can kind of touch on that. But I guess to put it simple, right, just a lot of fluctuations, right? So mind you, if you're at a 4% and you're getting a 299 or a 2875 or a 275 and it goes back up to a 299, you're still winning, right? Don't beat yourself up on it. If you could time everything perfect, I mean, there would be no point to life. I mean, nothing's ever going to be perfect and perfectly timed. But if you're getting a rate and you're below 3, I mean, you should be pretty happy.
Yeah, but I'm getting this a lot. It's like I've got referrals and I give it to Mike. Mike, an employee of our company, basically writes all my referrals just because I'm doing a lot of other things. But the reality is, I'm getting texts like, and I saw 1.99, right, and they're at like 2.99, right, because there's no like I don't want to charge a lot of points if it makes sense. And there's a lot of different things that make sense depending on the situation. But there's a lot of advertisements out there that are like making people think that they're not a good deal when they're in process with the lender that they're with, because everybody's trying to get that bait out there for them to come in and try to see. But a lot of times, the lower rates, Brad, they come with a lot more points, right? It's going to cost you more money to do it, but people get so fixated on that rate sometimes that they don't think about the actual mathematics involved with what makes the most sense for them, right?
Yeah, people get fixated on the rate. They don't really think about the cost, and it's hilarious to me because people get so fixated on the rate, and 6 months after they close, they have no clue what rate they have.
Yeah, ask them what their rate was. They're like, I don't know.
I don't even know what rate I have, and I just did my mortgage like 3-4 months ago. I have no clue what I have. It's ridiculous. It's like caught up in the moment, short-term thinking. I mean, it's got to make sense, and it doesn't always make sense to pay all the points and to roll all those costs in. Majority of the time, it doesn't make sense because most people don't stay in their loans, in their mortgage, for more than 6 to 8 years. They're going to refinance, they're going to sell, they're going to move, they're going to do something. They're not going to be in that loan for 30 years, majority of the time.
Right. And typically in the past, it was always not about paying points, right? Just because rates continue to slide and, hey, we think, 375 is the bottom. Well, clearly it wasn't, right? So people paying points then are losing out now, right? But this truly could be near the bottom or close to.
Yeah, I mean, this could be
right
forever loan, right?
It
could be a forever loan, like you don't have to touch it.
But even with that being said, you still have to do the break evens on, okay, if I get a 2.25 on a 30-year, it costs me $5,000 in points, but it saves me, I mean, if it saved you an extra $250 a month, that's worth it, right?
But it doesn't, right?
No, it's probably, save you an extra 50 or 60. And now you're looking at, an 80 to 100 month break even. And it's kind of like, I don't think that
we're talking 100 months, right?
Right. Yeah. And mind you,
it's a long
someone
time.
who's older, and they're like, no, I'm staying here, man. Sure. That makes sense.
Yeah. But, it can work for them.
As a lender, some of these rates that are available on a rate sheet, I mean, they can't even close on them. It will fail QM. There's only so much that a consumer can be charged for a loan, and the points become calculated into this calculation. You can't even do it. I mean, it's great that they put that out there, and I get it. It's definitely got people talking about rates, but that scenario probably doesn't make sense often. I mean, if you're getting at a point, I think, especially, I mean, it's so funny. You talk to someone, they're like 3 and an 8. Ugh. It's like, dude, that's pretty solid. I mean, I would, people were like killing me for 3 and an 8, like 3-4 months ago. Now you're like looking at it like it's the worst thing in the world. I mean, people get greedy, and I get that. I mean, you obviously want the best if you're going to refinance and get the lowest, but people, just in general, people who are shoppers, if that makes sense, they often lose out potentially on the deal that existed in the beginning, right? Or they shop it all around and they end up going with someone, and then the rates drop and they try to shop again and something happens, they don't close on their loan. So you do have to act on something that makes sense. I feel like it's not about always getting the lowest rate.
Right. I'll give you an example. Right, if you're shopping a week ago, right, the GSEs or the Fannie and Freddie added fees on top of their pricing, which was basically like 50 basis points, which is a half a point, which is, on $100,000 loan, that's $500 more that you're going to pay for the same rate. If it's, so on and so forth. You might have been shopping for the best rate, but you're trying to hit a moving target because we all woke up and overnight we lost 50 basis points on all our deals because they implemented something. And potentially if you're shopping back and forth and you were making your decision right around then, well, you calling back that same lender, they gave you that great rate that you thought, and it was different. Right.
Yeah.
And it changed overnight. It's like trying to, time the Apple stock or something like that. You buy it at whatever, and then it drops and you're like, shit. Right. Or it goes higher and you're like, hey, I won. Right. But you have to be okay at some point making a decision that this is going to be good. And really, guys, what's the difference between like 3.125 and 2.99 in payment? It over time does add up. Don't get me wrong. But the reality of the matter is, if you're trying to like fish for that 2.99 and overnight rates go up to 3.5, then you just lost it no matter what. You're just, because you're trying to like time it. You know what I mean? It's just tough. I just think that call someone you trust and that's going to be fair, and there's a lot of value there. You're going to get a good deal. I want to also talk about loan officers and how they get paid. In the past, loan officers would get paid for giving you a higher rate, right?
In the past.
Because they can make what's called yield spread. So if, like, let's say the base rate was 3%, and as a loan officer, I gave you 3.25%, but that difference in rate paid us back as a company, let's say $3,000. Well, in the past, a loan officer could keep that money as what's called premium, right? And they were incentivized basically to give higher rates. That changed back in 2009, right? Our loan officers do not get paid more or less if they give you a higher or lower rate. There is no incentive for a loan officer to charge you more. Now, there are incentives for certain companies because they can make more money. So from a company to company standpoint, yes, you will see some variations on what they decide what their margins are. But the reality is that loan officer does not get to choose what they get paid on that deal, whether they give you the lower rate or the higher rate. So they're not incentivized to give you a higher rate. They want to get the deal, period, right? So if you're shopping for a mortgage, don't think that the loan officer is in any way, shape, or form incentivized to give you a higher rate. It's illegal to do that, right?
Same with points. Points don't go to the loan officer either. Points are what that rate costs to get for you. It doesn't go to the loan officer.
Right. It doesn't.
This asshole isn't charging me points so he can go out to dinner. No, it's charging me points because that's what it costs.
Right. Another thing that's happening right now, guys, is equity in homes is going up because the price of homes have gone up. There's multiple sale offers. There's a lot of sales happening right now over ask because there's not a lot of inventory. So a lot of people might have more equity in their house than they had before. They might be able to get out of private mortgage insurance. They might be able to pull some cash out and consolidate debt. I believe people's equity positions are going up across the board. I mean, not like crazy, but they are going up. Well, so your house, go ahead.
Especially in Fannie Mae system, with all the with the pandemic, they've kind of gave some wiggle room on values, and it's funny. It kind of goes, teeter-totters between Fannie Mae and Freddie Mac, who's kind of giving the farm away when it comes to values. Like right now, it's Fannie Mae when you're running through. Just for the listeners out there, it's all approval based on like basically an algorithm, right? There's all these different inputs, and the system analyzes it all and gives a thumbs up or thumbs down. And within that, it says, like, for example, if you're self-employed, you can either use 1-year tax returns or 2. You need this type of an appraisal. There's different types of appraisals that Fannie Mae or Freddie Mac will accept, or if you don't even need one. So a lot of times on these refis, we aren't needing appraisals at values that are crazy.
Purchases.
They're much higher than what they would have been. So people are able to drop PMI or get into a lower loan to value ratio and get a much lower rate for their PMI. I mean, I got a lot of deals right now that were FHA with PMI on there basically forever. They're now getting a lower rate conventional, which usually wasn't the case, right? FHA rates were always really low in comparison, but they're dropping PMI, they're dropping a lower rate, they're re-amortizing their loan from 23 or 27 years to 30, and they're dropping like $200 or $300 a month. It's crazy, right? And if they take that money and apply it, they're either going to pay their house off way faster or put it in another investment. So a lot of refis make a lot of sense, but some of the people who are like, well, I refied to 3.25 in February, and now I want to try to get 2.99 or 2.875. I mean, that's just kind of pinching pennies, because nothing's free. There are costs associated.
You got to pay. Yeah, you're gonna have costs. You got to do title work. You got to do potentially an appraisal.
If the lender's able to cover all those, great. Right?
Yeah.
But that's typically not what is happening right now because everyone's margins are so thin across the board.
Yeah, I want to talk about the property inspection waiver for a moment. So Fannie and Freddie, they collect data on houses, right? So for example, Brad, we're doing my refinance right now, and we got an inspection waiver. It said my house was worth $400,000, right?
Sure.
I don't think I could sell it for $450,000, to be honest with you. I don't think you know what I mean. But Fannie Mae said my house, with my house being worth $450,000, which gives me a ton more equity than I thought, which is giving me a better deal. Don't assume your value is, or don't assume that you don't have enough equity to refinance potentially because you just bought your house 6 months ago or a year ago, or houses, because Fannie Mae is basically saying we will refinance this at this value of the house. We don't need an appraisal and you're good. So it is so imperative to talk to a loan officer and actually have them run it through Fannie and Freddie's website or system to find what's available to you. Because like you said, Sal, you might have an FHA where you put 3.5% down, but you run it through Fannie Mae, and that house that was worth $150,000 when they bought it, they might be like good with it, like 190, right? And all of a sudden now you have all this equity, you have a much better deal, you don't have PMI, it'll literally save you hundreds and hundreds of dollars. And another thing is, with the property inspection waiver is you probably won't get it on cash out, just so everybody knows. If you're doing a cash out transaction, they're going to want to do an appraisal on that to make sure that the house is worth what it is, because you're pulling equity out of it, right? Fannie and Freddie are more apt to not have to do an appraisal if it's not a cash out. Have you guys seen any cash out transactions with property inspection waivers at all?
No.
No, right?
I think we got like one or two,
They're rare though, but they're pretty rare.
I've been advising, my clients to a degree, like, hey, maybe just wait unless you need it right away, because cash out adjustments were crazy for a while, and I feel like they're starting to get more in line with rate and term pricing. So
yeah, let's talk about I was gonna say let's talk about
getting like a high twos, right? Cash out, they make adjustments, and by adjustments, that they're adjustments in points on the back end, right? So unless you want to pay those points, which, for example, on some cash outs, it was like 1.5%. So if it's a $300,000 loan, you're talking like $5,000, right? That you're essentially going to have to pay in points, or take the rate that covers that $5,000. So instead of the 2.875, you're now looking at 3.5, 3.625, which, hey, if you're at a 4 and it accomplishes all your goals and you're lowering your rate too,
right?
If you're using to consolidate debt. But I have a lot of people call me lately like, hey, can I get like 5,000 to 10,000 cash out? And I'm like, don't do that. Why don't we just
because you're gonna pay 5,000 to pull 5,000 out, right?
Go get a personal loan,
right?
Depending. I mean, if it's sometimes it's let's consolidate the items, or I'm sorry, the credit cards or whatever, and maybe it helps them out, and then they can refi again, because once it's a cash out, you can still rate and term it afterwards, unless you're in Texas, right? Like that's, I think, the only state where once you pull cash out, forever it's always a cash out, right? But with the rest of the country, I mean, you're able to basically, take cash out. If rates are still low in 6 months, we'll bring it from that 3.75 down to 2.75 or whatever it is, right? But right now, cash out is expensive to take out, if that makes sense.
It is, yeah.
You're gonna roll.
So I want to explain I want to explain that. So like, COVID happened. So when there's a deal that has higher risk, unfortunately, you get charged more money for that higher risk, whether it's perceived risk or real risk. And cash out in the grand scheme of things is a higher loan because you're pulling equity out of your home. So you're getting hit points to do that. Also, adjustments on credit scores are across the board brutal. If you have a 720 or higher, you're probably going to be okay, right? 740, 760. They're like, those are the bucket that you're going to be good. Anything above 760 is top tier. 740 is really good. 720 is right there. You start getting below 700 on your credit score, you're not getting 2.99, right? You're not getting away with not potentially paying points because that's the way the rate sheets work right now. So if your credit score is on that line, there's a couple things you can do. And I don't think enough people do this. Like when we look at credit and someone's got a 699 credit score or 719 credit score, sometimes we run an analyzation and we can very easily do what's called a rapid rescore. Sometimes, like you might have a credit card where you put on, you bought something for $2,000 and your limit's $2,500. And if you were to pay down $1,000 on that card, it might pop your score up 20, 30 points because utilization of credit is a really big factor in credit scores, right? And a lot of people don't even know how the credit affects their rate because they think make all my payments on time. I made my mortgage payment on time. I make good money. Why can't I get the best rate? Well, it's because you've got a credit card that's maxed up, that's dropping your score 30, 40 points, and you're going to be in a different bucket. But if you have a good loan officer, they're going to look at that and say, listen, man, let's pay that down. Let's do it the right way. Let's get you the best rate possible. If you have the money, right? Pay down $500, $600, $700, $1,000 on your card. You're going to get 10, 20, 30 points and put you in a different bucket that could save you a half percent in rate. Really? Like if you're below 700, you really want to try to do whatever you can to get that above 700 or 720, right?
Yeah.
Yeah, I mean, it makes a lot of difference in the pricing, and maybe not as much if you have that, 20% equity. It might be like an eighth of a point or something, but definitely with PMI, especially if you've got minimum down right now or you're purchasing, trying to get the best that you can. And a lot of lenders will allow you to do that during the process even, rescore your credit and take advantage and do that. But it is something that you got to definitely take a hard initiative to do, right? Like, hey, I need you to pay it down to this dollar amount. I need you to get me the documents. I need to submit it. It's a time-consuming process. And, just like everything else in our business right now, I'm sure it's taking longer because of, COVID. People aren't necessarily all in the office. People aren't, companies are harder to get a hold of. Turn times are taking longer, appraisals are taking longer. So, if that's the case and you're borderline on your credit, definitely talk to someone, whether it's a loan officer or a credit repair company, take the time to do what you need to do to try and get the best. But don't say, well, I'm going to wait for my credit score to be 740 so I can do this in 6 months, because the rates might not be there and you might end up getting a worse rate than what you could have with your lower credit score. I see that happen sometimes. I'm going to wait, man. I got to, 710. I'm going to wait till I'm a 760. I want to get the best rate. Well, you just shot yourself in the foot because, the rates went up. And people all the time ask me, I can refi in like 6 months, whatever, right? Yeah.
Yeah.
You can, but why would you? Maybe, right? I mean, obviously, if the rates are lower, then yes, you can, but often they aren't. And I think people who are buying right now need to take it real serious that like this might be the end of, the low rates for the foreseeable future. It might go up. I mean, 3.5 is very low rates. Very low rates. And they could be there in, 6 months. And people will tons of people still be able to refi. I'm refinancing so many people that are at like 4.75, 4.875 that literally could have refied 3 times over in the past 2-3
right.
years, right? And it is funny too, like, sometimes we try to put a call to action to people and message them, hey, you're at like 499, you should refi. You should think about refinancing. I mean, we could put you on a 20-year loan and give you the same payment, and you pay your loan off 9 years faster. But some people just don't.
You know what's funny about that? How many conversations I've had in the past with people where I was saving them $100 a month for free because we're doing no cost refinances a lot back there. We really can't do them that as much now because the rates don't pay back the same, where we can't absorb much. But I would tell someone, listen, I'm saving you $130 a month. Yeah, I don't really feel like doing it right now. Right? In my mind, this is what I want to say to them. Right? If you had a 401k or an investment and you could make 1 extra percent on your investment, right? If you can lock in, and this is a locked in like savings, which is a little different than investments. But if I told you had $100,000 in the bank and I could guarantee you an extra percent return for the rest of the next 20, 30 years, whatever it is, people would be like, oh my God, you can lock in a full percent in increased wealth over the next 20, 30 years. Yeah, I want to do that. People look at that and say yes, but they don't look at their debt the same way. They'll look at their debt and they'll say, I have $300,000 in debt on my mortgage and I'm at 4.5%, and I could drop it down to 3.5%. It's not worth it for me. It's the same thing, only in reverse. You want to pay the least amount of interest on your debt, and you want to make the most amount of money on your investments. People focus on their investments, on the wealth growth, right? They don't focus on their minimization of interest paid on their debt. It's a weird thing that they don't look at it that way. And a lot of times what I would say to clients that didn't want to do it is, I'm like, dude, pretend like you didn't do it. If you're comfortable with your payment, because it sounds like you're comfortable with your payment, what if you made the same payment and you paid off your house in 22 years instead of 30? That's 8 years off your mortgage. That's like thousands and thousands of dollars of savings, all because you're too lazy to do the refinance. You know what I mean? Or whatever the reasons are that you tell me that. I just don't get it. I don't get why someone wouldn't want to lower their interest exposure on their debt. And it happens all the time.
Yeah, it does. And
right.
I think part of it is human nature. Humans by nature run away from pain and run towards pleasure. Right. So pleasure in this is their wealth, right? They want the wealth. They want to be able to retire. So that's like their pleasure. Their pain is all their debt. They want to ignore their debt because they don't want to deal with it. It's painful. They don't want to think about it. So they just ignore it. But you talk about wealth, they want to do that all day long.
I think too that, to your point, Brad, like people run away from the pain because for us, I mean, not that, I'm not going to say we're infallible or never have made mistakes or anything, but we try to really do a really good job for our clients to make sure the process is easy and transparent and quick or whatever. So it's not so bad to do another mortgage, right? But sometimes you talk to someone and they're like, oh my God, what do I got? I got to send you everything. I got to do all this. I got to fax. I got to scan for what? 20, 30 bucks a month after they just went out to, they just ordered a DoorDash that costs double that or whatever it is, right? But I think that sometimes people run away from the process because maybe they didn't have a good experience and it was kind of a pain, or they might have had a low appraisal or got burned in the past, or, a lot of people don't trust financial people. Like for me, sometimes like financial advisors, when they call me, I'm like, what's your load of bullshit today? Like, what do you want to tell me that you're going to beat around the bush around for 20 minutes? Or insurance people or whatever, right? I mean, that's just the nature. So I'm sure people, especially those who might be like a lead, great. Yeah, you want to do my mortgage. I know I filled that thing out on Lending Tree. Yeah.
And now my phone is ringing nonstop.
In the past, I filled that out and someone told me it was going to be free and it cost me $6,000, So I think there's a lot of people who don't necessarily even know what they're doing in this business when they do a refi. Well, I'm lowering your rate and your payment. That's it, right? Well, and sometimes that's all people are looking for, right? And that's why so many people do that, but they don't necessarily understand the implications of when they sell in 2 or 3 years, right? Or what the actual fees that were baked into the loan. So I just feel like a lot of different experiences exist for that happening. Like you go to buy a car, it's pretty straightforward, right? You walk into the dealer, you get financed basically pretty much there the same day, you walk out. It's all pretty fluid process with pretty easy numbers to understand. Yeah, okay, some dealers have a little bit of fees here and there, but you can have two completely stark different experiences with a mortgage, right? And
right.
We have different experiences with each of our clients. Each loan is different. There's so many things that go into it. It's a 30-day process. It's kind of crazy, you know? So I think that sometimes people are like, I don't care. My payment's low enough. Like, I almost look at it too. Like, when I was refining my car, it's like, is this worth it? Is it? I mean, yes, it is. If you look at the time it saves you, if it takes 2 hours of my time and saves me $60 a month or whatever it is, $100 a month, I mean, clearly that's worth it, right? I mean, it's like, a lot of money that you've kind of earned yourself for the amount of time that it took. And if you think about a refi that could save you $20,000, $30,000, $40,000 or gain that in your pocket when you go to sell, what is your time worth? Is the 4 or 5 hours that saved you that $5,000 worth it? $1,000 an hour? I think so.
Yeah, right? I'll take $1,000 an hour. That's pretty sweet.
Yeah, I don't think people think of it like that, right? Like, hey, 2 hours of your time to scan some documents, sign some stuff. Maybe. I mean, I don't know.
Well, you know what I hear sometimes too, Sal, is I hear, hey, I'm moving in 5 years or 3 years. I'm not going to do it. It doesn't make sense for me to do it. And what I always say is like, dude, I'm saving you $200 a month. Don't change your payment. Keep making the same payment. What's going to happen is when you sell that house, you're going to have more equity, right? Because you're paying down your equity exponentially. So no matter what, if you pay less interest on $100,000 or $200,000, it will add up over time. You might not feel it, but who cares if you don't feel it? Because it's like putting money away in the bank. Another thing that people aren't probably looking at as much, like I have like 20 years left, man. I'm at 4.5%. I've already paid 10 years into this. I'm not going to do it. Well, why don't you do a 15-year and keep your payment the same and lower your rate and shave 5 years off your mortgage? And then 5 years from now, you will have way more equity than if you did in the stayed in the same mortgage. Right. And then another thing we hear a lot is like, well, I'm already making extra payments. Well, then why wouldn't you make more of an extra payment by having a lower rate? You know what I mean? I feel like there's a lot of people that make excuses to not do it, or not even, at the very least, if you have a mortgage, you should be having a conversation with someone. You got to have a conversation with someone that knows what they're talking about, because you don't know what you don't know. Like my car, I know I should be financing right now, but if I had someone that I could go to, they're like, dude, you got to do X, Y, and Z, do it. I probably would be more apt to do it. I just haven't done it. Right. There's a million things in life that we procrastinate on and don't do them because we're just lazy. Sometimes I want to deal with it. But the reality is you got to at least have a conversation about one of the biggest investments you probably have in your life. There's not many other things where you're carrying that much debt on one thing, right? And to not optimize that as much as possible. It's like optimizing your debt structure is very important, especially when it's $200,000-$300,000 or more, right? And you got to make sure that you're out. Usually, with our business, Sal, we do a very good job being proactive and letting people know, hey, rates have gone down. You got to at least look at it. And whether or not they're receptive to that, that's up to them. But there's a whole host of people out there that just don't know where to go. They start shopping around online. They get a bunch of weird quotes. They're talking to someone in different states at call centers. It's just trying to hammer them in through the system. They probably don't trust loan officers, because loan officers have had a bad rep because most consumers don't totally understand the mortgages, so they just feel like they're going to get taken advantage of. You know what I mean? If you don't understand something,
I think there's a lot of negative connotations out there too, as to all right, refining is bad. Some people are like, oh, you're redoing your mortgage. I think a lot of people in the past, thought refining means taking money out, doing a bigger mortgage, which sometimes it does, right? And sometimes that makes sense. But a lot of people will ask me, is is it bad to refinance? Or is it bad I've refinanced 2 or 3 times? I'm like, not really, dude. You went from a 5 to a 2.875,
4 to a 3. Yeah. Right.
I mean, not really, but what did it cost you each time? Right.
Mm-hmm.
Or what did it cost you last time? I mean, if you paid all those points, I mean, you might want to think about it if you're going to pay points again, because now you got to take all those costs and say, all right, was it worth it? But
which is why doing no cost refinances like we did for so long, because we could, allowed people the flexibility, even though, like, so everybody understands out there, if let's say we're at that time 4% or 3.875%, and with the 3.875 it came with like $3,000 in costs, but we could do 4%, absorb all the costs, and that way there's no recoup time on that investment. If they ever come down again, you could refinance. So if your last refinance was a no cost refinance, it makes it very easy to refinance out of that, because you didn't have any recoup time on that investment. Now, if you were to pay $5,000-$6,000 in costs, and then you go pay another $2,000, that's $7,000. Yeah, it might not make sense. So you gotta be aware of what you did and where you're going. But what sometimes happens is with these online lenders and these clickbait type rates, people get so, like, Quicken's notorious for this, right? We work there, and I know for a fact they're notorious for this. They would advertise, like they're doing it right now. They're advertising 1.99 as your rate. And then you read all the fine print. It's like, comes with 4 points. It has to be $200,000. Has to be 80% LTV. You got to have 760 credit, right? All this stuff. And people are like, I want that 1.99. And they get the paperwork and they see the 1.99, but they don't see the $4,000 in cost because it's being rolled in their equity, right? Now you're paying interest on the $4,000 in cost to get the 1.99, which brings up that rate of actual cost for that loan over time, right?
And it made sense if you stay there 12 years or whatever. But
correct.
Now you go to sell in 3 and you're like, damn, I thought I would have got more money. I thought I'd owed less.
People don't think like that, but people don't think like, people want to wear that 1.99 on their lapel and walk around the office and be like, guess what I got? I got a 1.99. Then you get a call, be like, bro, my buddy just got a 1.99. I'm his loan estimate. Yeah, he paid $14,000 in points.
Yeah.
You know what I mean? It's like, what the fuck? Yeah, it's not a good deal. You know,
not really, man. I mean, it's definitely a different time right now. You know, like everyone's so focused on getting the lowest rate, and I heard so and so, and it is crazy, right? You give someone a rate too, and then 2 weeks later, you get a call from one of their friends, hey, I want the 275 or whatever, and it's like, well,
and you can't do it, right?
The loan was 400,000, yours is 100, so it's going to cost you.
Right.
I mean, the thing too with lenders and being able to give lender credits, and I'm finding this a lot. People are calling me with $60,000, $50,000 loans, and it's like, hey man, I heard you did so and so for so and so, and it's like they're at like a 4%. I mean, yeah, you could refi, but it will cost you $3,000, right? I mean, there's fees that no matter what your loan amount is, are static. Essentially an appraisal, title company closing fee. I mean, some move with the loan amount, right? Like lender's title insurance, points maybe might be cheaper on that. But the bigger loans have more meat on the bone, so the lenders can give lender credit. They set their margins, and maybe they have a dollar amount that the loan needs to hit, and the rest can be passed as a lender credit. So that is somewhat difficult, and the biggest loans get the lowest rates. That's for sure.
Yeah, I don't think a lot of people understand that.
I think the moral of that story is mortgages are fucking confusing. There's a lot that goes into it.
Yeah.
If you think you can go on the internet, type in your name and what you think your credit score is and what your house is worth, and be able to figure out your mortgage, you're fucking crazy. You need to call someone that knows what they're doing, that understands all these different little avenues and intricacies that are involved in a mortgage, and have a conversation and be honest about that conversation. What do you want out of it? Where do you see yourself? What are your goals? So that you can get a tailor-made package that meets everything that you're trying to do, or to the best meets everything that we can do for you. But you need to have a conversation. You can't figure it out yourself. They're too crazy.
Yeah. I'll tell you right now that like a lot of clients don't understand this. just so everybody's clear, the closing costs are pretty much static. Like if you have a $300,000 loan, your closing cost might be $3,000, and if you have a $100,000 loan, it might be $2,500, right? Like the difference isn't that big, right? If you have a $500,000 loan, it might be, $3,500, but like it doesn't move much with the loan amounts. So with those smaller loan amounts, you just have less room to play with, because if your margin is, let's say the one margin is 1% on that $100,000 deal, the lender might make $1,000, let's say. Right.
This is odd because I don't say this often. If you have a loan amount that's like below 75,000, the best place for you rate wise is probably a bank.
Yep.
They can make
or credit union. Yeah.
They can make nothing on the deal, and they're not going to turn anyone away or whatever. I mean, as a small independent shop, we can do small deals, but we break even on them or even lose on them. We
don't
end up making a couple $100 on the deal, and it's like, that's honestly, and I don't mean it because of any other reason, but it's literally not worth the time that we're paying people to do it. Paying people more to write the loan than they are, or whatever, right? So it's difficult. I think if you got a small loan, you should call your current servicer and see what they can do for you. Call a broker, see what they say. But when you have
call somebody you trust. If someone cares about their business and their reputation, like we do, we'll tell them not this place for you. I'd rather turn away a deal and give someone good information as opposed to try to force someone into making $500 off them, because that's greed and that's transactional. Yeah. And if you're working with a transactional greedy company, then you're going to get thrown into something and think you're getting something great, but at the end of the day, you're not getting like what you should be getting, because they're just trying to get money from you. Whereas when you deal with someone that's reputation based, they're going to try to lead you in the right direction. We're advisors. We're less like loan officers, but we're more like mortgage advisors. We're going to give you the advice that we think that you deserve and need, as opposed to just telling you what you want to hear. You know what I mean? Like that's the difference between a good loan officer and a shitty one. The shitty one is just trying to get your deal at all costs, right? Close. If you ever hear someone say this, yes, I hear what you're saying. With that being said, you should do the loan because X. That's called an ARC. That's an acknowledge, reply, close. That's what happens in a lot of phone sales, right? They want to close. So they don't want to get you off the phone, because they know once they get you off the phone, you might not talk to them for a while. So if you're on the phone with an online lender, you're starting to feel pressure, get the fuck out. You shouldn't feel pressure to do a mortgage. You should be given the information. You should be given all the options, and ultimately it's your decision on which road you want to take, if you want to take any of them at all. But if you're on the phone with someone and they're hammering you to do the deal, that probably means they are transactional and they have to do a lot of volume to make money, because a lot of online lenders pay their LOs a lot less per deal, because they do 20 or 30 or 40 or 50 a month. Like people like Quicken can do up to 60 loans a month, and their just whole incentive is to bang through loans as much as possible and get them in the system. That's their model. Whereas if someone is reputation based, and that's all that like our company, we are reputation based. We can't afford to have people walk away. Those guys are assholes. We just can't do it. Right. And sometimes people think we're assholes because we give them the right advice and they don't like it. You know what I mean? It's a double-edged sword, because sometimes we'll say, no, dude, that's not how it works, and blah, 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 blah. But they've got this other guy saying, oh, I can do blah, 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 blah. And they come back to you and say, dude, you're a liar. And I'm like, okay, go figure it out. And how many times have you gotten a call back and said, oh, man, you were right, man. Can we still do what you said? You know what I mean? Unfortunately, there's a lot of bad apples in our business, because when there's a lot of money involved with these transactions, there's a lot of unscrupulous behavior. Shitty humans everywhere. Yeah, shitty humans that just want to fucking make money. But what I'll tell you is, if you can find a good one, then you're gonna, that's the goal. Find someone that you can at least trust, and if they're smart and they value their reputation, they're going to be very upfront with you. I tell people all the time, you want the lowest rate in the country? We're probably not it, because there's there's thousands of lenders, and there's lenders out there that are just bottom of the barrel, and but things suffer from that. When you have value, it's a fair rate that's within market or below market, and it's also someone that's going to not fuck you up long term, right? there's a lot of fuckery that happens in our business. There's a lot of fuckery. You know what I mean? But yeah, I don't know, man. Where do you guys see the market going? I mean, do you guys think that like, look, I'm really kind of concerned between you and I about this winter. This winter is going to be very telling. Look, the holidays are usually a slower time anyways, right? But if we have another round of this, I mean, we already are starting to see a lot of like other shutdowns. And I mean, this COVID thing is not going away.
MSU and all online.
What's that?
MSU just announced all online.
Yeah, last night.
Yeah,
they canceled their moving.
Yeah.
So, of course, all the other universities are going to follow suit. Like, there's going to be a lot of things that it's kind of like, you think about all the jobs that are employed by, or are facilitated by a lot of different things, like even, keeping up, janitors and whatnot in these buildings that aren't being used. It's like, man, what is going to happen, right? And what can we do? But
think about this. College football, one of the highest revenue producing sports in the country. College football generates a lot of money. It creates a lot of jobs. Vendors at the stadiums. You've got sales of apparel. You've got all those people that are like rely on the industry are not going to be working, man. I mean, they've got, you know what I mean? There's a lot of people that get employed through college sports. There's a lot of people that get employed through colleges being run by colleges. There's a lot of people employed by professional sports. Like they're talking about having a football season without fans, right? Like this COVID thing is creating a complete shift in our world. I do think though, guys, if you're in an industry, this is my opinion, and this is kind of off topic, but if you're in an industry that you see like is being affected by COVID and you're holding on to the hope that you're going to go back to your world as you knew it, you should stop doing that and start looking for emerging industries that are embracing the new world that we're in, that's going to have legs going forward, because I don't think that our world will ever be totally the same. You know what I mean? Like I was golfing yesterday and a dude was golfing with his mask on. I don't know why, but like he felt like he needed to wear a mask while he was golfing. And that makes me think, like, are you like people's fears, the herd mentality of people, like, it's just so weird, man. It just, this isn't going away, right? The COVID thing. So we got to live within it. That's why I'm like wondering this winter with the housing market, is it going to stay hot? Home purchases are nearing equal levels with refinances right now because there's so many people buying houses. That was an article that I read the other day. So think about that, right? Refinances are so prevalent. Home purchases are so prevalent. What's the fall of that? Capacity. You better, if you're going to buy a house right now, don't do a 30-day contract. I know everybody wants to close in 30 days, Sal, and you see this, dude, and we do it. We get it done. It's a fire drill, bro, because it's like, it's not even on us. It's trying to get a VOE back. It's trying to get, all these different things, appraisals, right? Everything is being stressed as far as capacity. So to assume the loans are going to be closing as quickly as they were prior, that's not fair. And I think real estate agents have to start acknowledging that it is going to take longer. Now, the good ones are still going to be faster than the bad ones, right? Banks and these large companies are probably a little bit more cumbersome. It's probably going to take a little bit longer than someone that's like nimble like us, and we can kind of navigate things. But even us, as nimble and as many options as we have, because we have the option of placing that file where we think it's going to get processed most efficiently with the best rate. And sometimes the best rate is not the best place to put the loan because it's going to take 3 months to close a purchase. You don't want to do that because they're so backed up, right? But if I can go over here with this other investor and the rate's an eighth higher, but it's going to close in 35 or 40 days, that's probably more important on a purchase. So I think people today, especially when buying a house, have to stop being so focused on getting the lowest rate, because that lowest rate might cost you that contract closing on time. Am I right on that?
Yeah. I mean, you got to,
you know what I mean?
You have to have faith in your team, I mean, I had someone who was like, hey, Bank of America or whatever is doing this. and it's like $1,000 different. And I'm like, well, but they need an additional 60 days on the contract. So they wanted it to be a 90-day contract. So I go, honestly, I mean, you can try to get that to work because I can't give that. I mean, we're already, pretty thin on our margins here. So we're not going to really be able to match or do anything like that. But I don't know necessarily that you're going to end up getting that house. And
right.
I don't know what happened with that. I know they didn't use me, but I don't know if they got the time. Pretty crazy.
Right. I do believe that there is instances where debt consolidation is a huge thing that you can do right now, because if you are below 75% and you're pulling cash out up to 75% loan to value, and you there's room to do that, and you've got $20,000, $30,000, $40,000 worth of debt, if you can roll that into your mortgage, you can optimize your debt that way and pay it off faster, because your payment on that debt, whether it's credit card, I mean, people don't understand their credit card debt, if they make the minimum payments, takes like 20 something years to pay it off, right? Mm-hmm. If you've got $10,000 in credit card debt and you're making the minimum payment at, like, even on the best rate, which is like, let's say 12.99 or 14.99 on your credit card.
On a credit card?
That money's, usually it's in the 20s.
Usually it's in the 20s.
Yeah, but if, like, there's some that are there's some. My point is, you make the minimum payment on that, that's like a 20-year loan. You know what I mean? So if you can put that in your mortgage and just make that payment towards your mortgage, you're going to pay it off much faster. So if you do have that, and you've got to do an equity analysis, and if there's room there, then you should try to consolidate the debt, because you can put yourself in a better position. And I think a lot of people there's a lot of equity in our country that isn't being utilized correctly. A lot of people have their homes paid off. Here's something that's interesting. If your house is paid off and you can borrow money at 2.75 or 2.99, that is like some of the cheapest money that you will ever get. Ever. You will never be able to borrow money for cheaper than that, in my opinion. You're not going to borrow money at 1% or 2%. You know what I mean? So if you have a lot of equity in your house, that's fake money until you cash out or sell the house. If you pull that cash out, pay 2 point whatever on it, returns on the stock market, just for instance, and I don't suggest this, you probably want to talk to your financial advisor, but let's say you get a 5% return on your money. That's low, right? Let's just call it a 5% return on that money. You're making a spread of 2% on that debt, right? So you're paying 3% here, you're getting 5% here. You're actually making 2% on money that you don't even have to do anything with. All you're doing is moving your money from here and putting it in a place that's gaining interest, and you're paying a little bit of interest here. There is a spread that you're going to make money on, right? So I don't know that a lot of people kind of think of it that way. I think it could be. I think your equity in your house, with as low as rates are, can be utilized for investment purposes if utilized correctly. That is obviously a high risk maneuver. You have to be willing to do that, but at the same time, if done correctly with the right team, you can actually gain wealth by doing it, right? So I don't know. I think a lot of people have got to look at that. I just think people are shying away from even having the conversation because they don't want to deal with it. They don't want to deal with refinance. It sounds so shitty. It's like, oh my God, I got to refinance my house. I got to get my W-2s. I got to get my pay stubs. Fuck that. I did it last time. It was miserable. Be miserable for like a month to save up the money. That's what I'm saying. You know what I mean? Like, why not? Even if it's shitty.
It's not that demanding.
It's not that bad. Yeah. It's like saying, like, I have a growth in my leg and I don't want to get it checked out because I don't want to deal with the doctors. No, dude, you got to go get it checked out because you're hurting yourself by not doing it, right? If you are overpaying for your mortgage, you are literally, this is what people don't get. If your rate is out of market, you are choosing, it's a choice to pay more for your house and pay the bank more interest. You are choosing to give your money away to the bank. In essence, taxing yourself. Nobody likes being taxed, but they'll take a 1% tax on their mortgage. You know what I mean? Like, it's in this world, you're given an opportunity to lower your interest rate exposure, and you don't take it. Shame on you. You know what I mean? Shame on you for at least not trying. Like, even if you think you have a great rate, call someone. Just have a conversation. Maybe you do have 3%, but you owe $100,000 and you have $50K in other kinds of debt where you're paying 20% on, and your effective rate when you combine everything, because here's the thing, debt is debt, right? If I have $100,000 on my mortgage, I have a $50,000 camper, and I have a second home that's $100,000. My primary house is worth $500,000. Your effective rate on all the interest rates could be 6, 7, 8%. But if you combine it all on your mortgage, your effective rate now is whatever 3% is, right? And it's not like you have any more or less debt. You're just moving the debt around and putting in the the smartest vehicle possible to pay the least amount of interest. You know what I mean?
Yeah, that's, I think, when cash out really makes sense. Because you'll just get eating the bits on all the other stuff. I mean, you look at like how much money you're paying in interest on everything, and mind you, a mortgage is kind of front loaded with the interest. So, you do pay a lot of interest with a mortgage still, maybe versus making extra payments on your credit cards or whatever. But
no, because credit card payments are compounded. It'll never be less if you make minimum payments.
Well,
you'll always pay more on your credit card.
I get that, I guess, but I think it depends on your ability. Obviously, if you could just pay them off, you could pay them off. But I do see a lot of people have the money in the bank, but they would rather keep the money in the bank than pay off the credit card. But if, just depending on your mortgage situation, right? Like if you're able to, because every dollar you pay above the minimum goes straight towards the principal, right? But if that mortgage costs you $4 or $5 grand to take out, but it does help free up monthly, and you can roll everything to pay off $5,000, $6,000.
You got to do the math, man. You got to have someone. You got to do the math. Have someone that's competent, and be able to Yeah. I mean, every situation is different, to be fair. And I think if you have a good LO that's going to take the time to kind of work through your full financial picture and try to figure out what's the best for you, here's the thing too. If you're a consumer right now and you call a lender and you tell the lender what's your rate and they give you a rate, that's bullshit, because they don't know anything. They don't know anything about you. If that LO takes time to get the disclosure of where you're at, they understand your situation, you do get your credit pulled. And I don't care what you say out there, guys. I know a lot of people call me and they'll be like, well, I don't want to get my credit pulled. Well, then I can't tell you exactly what it is, because credit scores make such a big difference in what you qualify for in today's market, that I need that as a tool to make sure that I'm giving you the best deal. Now, I understand that, like, if you just had your credit pulled and you're comparing, fine, I'll run it for you and let you know for first. But if you really, really are serious about it, get your credit pulled. It's not the end of the world. It's a mortgage pull. Just shut up and get your credit pulled. It's not that big of a deal, So I just want the audience out there to be. I mean, I know we just did 2 shows on this, but the reason I want to do is because it's so important to understand that refinancing is. There's so many millions of Americans that will not do it. There are millions of Americans that will stay in a higher rate because they don't want to call anyone or get whatever. And don't just call your bank, please, for the love of Jesus. If you believe in him for anything, do not just call your bank. Your bank is holding your mortgage, right? What's their incentive to really give you the best rate? They want you to pay more interest, right? You have to compare, dude. You have to compare at least with, I would say these are the 3 people you want to compare with. You want to compare with a local person that you were referred to, that people trust and they have a good reputation. You want to compare with your bank and see what they're at, so you have a good comparison, right? And then if you really want to get crazy, call like some shitty online lender in Wisconsin or whatever and see where they're at, right? You know what I mean? And then you have a good litmus, and then ultimately don't choose the lowest rate. Choose the company and person that took the time to give you the respect that you deserve, to make sure that they're putting together the right product for you, and just trying to slam you into something that looks sexy, but underneath the hood, it's all fucked, right? So that's it. I mean, that's what I wanted to really talk about. I mean, you guys think that, last thing I want to ask, Sal, I'm actually asking this. The stock market is doing really well, really, right? Is that reflective of our economy, or like what's going on with the idea that all this money is going to the stock market? I don't know that it's reflective of our actual economy, right? I think a lot more people are going to start struggling once all this stimulus runs out, man. We're just, see delinquencies. Delinquencies are starting to go up. They are.
I economic guru, but I mean,
no, you're not. I know that.
Yeah, I mean, a lot of money's in the stock market right now because, first off of how low it dipped, lots of people saw opportunity to do that, right? And try to make some money. Now they're holding on. Is it going to go higher? Is it going to go higher? And I think that the rug's going to get pulled out from underneath people at some point. But I don't know if that's going to be a, hey, it's crashing at the end of the year thing, or if this is something that's another year or two. I mean, I don't even know if it'll necessarily be a crash, but definitely a correction, I'm sure, is due. You can't print that much money and create that much debt for our economy and, artificially kind of boost all these companies up with forgivable money that still is a debt, right, to someone. I mean, it's not necessarily a debt to the company or the consumer with these PPP loans, but someone owes it. The government knows it, right? So what's going to happen to a lot of the, government treasury bonds and things of that sort once the real value of the dollar kind of comes down? I mean, that's really what I think the whole crux is of our economy is right now, the value of the dollar.
Inflation's going to be real, dude. Inflation, inflation is a real concern right now. And
if inflation happens, we're going to be in trouble. But
I think we're already seeing it. I mean, cost of goods like groceries have gone up, right?
I think the economy is a whole another show, man. We can talk for a while on what the economy is going to be. I don't think we need to get in too deep on that right now.
All right. I'm going to ask you guys 3 questions.
Oh, Christ.
Or do we want to do the thing where we each have a question that all of us have to answer? Do that again?
Sure.
All right. Sal, if you could open up another business where your monetary wealth is not an option, meaning you could do anything, right? You could be a philanthropist, an archaeologist, whatever. Sal, what would you do? What's that?
I'd open a small pizza shop.
Pizza? I would eat at your pizza shop so hard. You would make some good ass pizza, bro.
If that's all I had to do, yeah. I mean,
what would you call it?
Sal's.
Yeah.
It'd be a done deal, man.
I disagree with you, Sal. I want you to open up Sammy's. Because, by the way, so everybody that knows Sal prior to his professional career, he's known as Sammy. So I know him as Sal. I've never known him anything but Sal. When I started hanging out with Sal's friends and family from his past, all I heard was Sammy. I'm like, I don't know, who the fuck are they talking to? And Sal was like, yeah, they all call me Sammy. I'm like, then how did it turn into Sal? He goes, I don't know, man. So I want you to open up Sammy's.
Yeah, I mean, that's what I would do. I mean, if obviously making money wasn't the goal, right? That would be my ideal situation. I don't want to do anything crazy and complicated and all this stress. I just want to open a pizza place. Yeah.
I just so everybody knows, Sal went on the keto diet and has actually lost weight, and he looks fantastic. I don't know if it was the black shirt you were wearing yesterday that was slimming, but you look good, man. I'm proud of you. Yeah,
no, I think it's not that hard. It's kind of like refinancing. You just got to do it.
Yeah, right.
It's so good.
Brad, why don't you go? Brad, I think you need the keto, bro.
No,
you're not doing keto.
No.
So what would you do, Brad? What would be your thing? What would you do if there were no options?
I would open a small metal fabricating shop or a small engine shop and just fucking tinker in the garage all day.
On what?
Building shit, welding, building engines, just tinkering.
Yeah. You know what I would do? This is what I would. I would move to somewhere away where nobody knows me, and I would work in a convenience store as the stock guy, where I would just go into work, get a little job, say hi to people, talk to them, go home, sleep in a cabin in the woods, and not have to worry about fuck all, have zero expenses. I'd ride my bike to work, and I would just live the most simple life possible. and just disappear. That's what I would do. That's what I would do. I wouldn't want to do anything else. I just wanted, like, there's something to be said to just doing like a mindless job, like repeatedly every day that doesn't like when you're stocking shelves, like you don't have like rate lock expiring, or you know what I mean? Like you don't have all these things happening. It just, I sometimes I almost think like simplifying my life would be just very, very happy, but I'm not there. I'm doing a podcast and I got to do this thing and you got to do that thing. And that's where we're at. That's who we are. All right. You guys want to do another question or no? We're running out of time. So
no,
we're good. All right.
Yep.
Guys, thank you for listening to the show. Hopefully we gave you some insight on refinancing. Next week, we'll be starting back up with getting some real professionals in the air on the show to talk to us about what they're feeling and seeing on the actual housing market. I think we get back. We spent a lot of time on mortgages, but I think next week we get back to doing some real estate and really talking about, people are some challenges in actually like buying and selling homes, because I think that has to be talked about. So, but I love you guys. I love everybody that's listening. Please, again, go to iTunes, go to Stitcher, go to Spotify. Please like, share, follow us if you like us at all. If not, I don't care if you don't like us. If you've spent this time listening to us and you don't like us, then please don't ever tune in again. I love you guys. We'll see you next week with actually much more real estate talk and buying and purchasing homes. We'll talk to you soon. Goodbye. Bye-bye.